IFRS 9, financial instruments. Now, this is a very good accounting standard because it's very simple to look at. It has some principles that you must take into consideration. And if you take the principles for granted, then you can be punished a lot. But the idea about financial instruments occurs like this. Please note that all the time, financial instruments has two sides. So there is always two sides of the coin. On one side of the coin, there is going to be what we call financial assets. On the other side, there is going to be what we call financial equity, or if you want, liability. The way you categorize financial instruments as an asset or a liability, or as an asset or an equity, is whether the entity has an obligation to repay the financial instrument. So that's the key word. When the entity has obligation to repay it, then we categorize it as what? A financial liability. But if the entity has no obligation to repay, then we categorize it as a financial equity. Very important. Very important.
If they do not have the obligation
to repay, it is an equity.
An equity.
But if they have an obligation to repay, it's a liability.
Oh, okay.
Does it make sense?
The obligation not to pay is like a capital.
It's a capital.
Okay.
It's a capital. So let me make it sensible for us here. One, let's say A and B. So number one, issue of shares. Issue of shares. So let's say A is the issuer and then B is the buyer. So when A issues shares, what does it mean? It's shares. So A being the issuer will categorize that share as what? An equity. Why? Because they don't have an obligation to what? Repay anything. It is shares. Are you getting it? It is shares. But the buyer of the shares will categorize it as what? Financial assets. Because you have invested into a business. So the money or your investment will be categorized as what? Financial assets. Number two, issue of redeemable loan notes. If it is a redeemable loan note TNA, it means the entity issuing has an obligation to what? Repay. So they can't categorize it as equity, they must categorize it as what? A liability. So this is financial liability. But the attorney there, all the time, he's all find it for what? Financial assets.
Issue of redeemable
loan notes. Loan notes. You got it? Loan notes.
You mean A?
Yeah.
Is issuing what?
Redeemable loan notes. Like loan notes that you have to repay for it.
Repay.
Yes,
Okay.
that is why he categorized it as what? A liability. Does it make sense?
The issuer,
Yeah?
a liability
Yeah?
to the issuer.
Yeah. You are issuing loan notes and you have an obligation to redeem it, to repay it. So it's a liability to you. This one, the shares you issue, you don't have an obligation to repay. That's why it's an equity. Do you see the difference?
Loan notes, still.
Loan notes need to say borrowing.
Okay.
So instead of the company going to the bank to borrow, no, obey issue loan notes. So you come and buy the loan notes. It means you become the creditor. Between they will cash into who bought me bossian.
Okay.
Are you getting it? So it's like shares, but this time around, no, you are a creditor. Are you getting the idea? So since you are a creditor and it is a redeemable loan note, I am supposed to what? Pay you back. Are you getting the idea? So the issuer will still
So
be.
does it mean that the paying back, you are going to redeem the loan note again?
That's
Or
it.
inform
That is
that-
why it is a liability. Redeemable loan note means that the loan note you've issued, at the end of the day, you will pay me back the money I've given you. That is what it means by redeemable.
Okay.
Are you getting the picture?
Okay.
So you've issued a loan note. I have bought it. Mikita, maybe mama will sika. It's a loan note Nikita me no later I'll buy the redeem. The way you redeem the loan note and take back your loan note is to give me my money.
So it's like debt.
It's debt. Not like debt, it is debt. Are you getting it? So instead of going to the bank to borrow, we issue the loan note.
Loan notes.
Does it make sense?
Yeah.
Okay.
Then there could be sale of goods. Sale of goods with repurchase option. Now I want you to get this carefully, because this can be in a footnote, note I, to income statement question you are preparing. Sale of goods with what? Repurchase option. TNA. And I've sold the goods to you. And the goods I've sold to you, per our agreement, I have a right to come and buy back what? The goods at a premium. Is that a sale?
Like sell and lease back.
Sort of like sale and lease back. But this around, we are not leasing. The goods will still be with you, but I have an option to come and buy it back sometime in the future, maybe at a premium.
At a premium.
Is it a sale? It is not a sale. The money you are giving me is a loan,
It's a loan.
and I'm using my goods as a collateral facility. So,
What
come.
if you decide not to buy it back?
Hey, it's a contract. You are signing document, so you buy
Sale of goods
with purchase option. Are you getting it? So the option is there. You have to buy.
So it's not always that you buy it at a premium.
Yes.
You can buy it at
No, now so you always it's always bought at a premium because there is a coupon rate on it. It's like I'm borrowing you, lending you money, and you can't put your asset on the board, so you put some of your goods on the board as a collateral facility. So with that one, the seller, okay, we treat it as what? A financial liability. But the buyer, only a buyer, still like to treat it as what? A financial asset. So this particular sales with the option to purchase cannot be added to the revenue of the company. Into a betty and free revenue name, so on the account that Nasa Sikano, yeah, the account balance sheet move as what? A financial liability and a non-current liability. Now on that money, you bet you have interest. So whatever coupon rate is in the agreement, we will charge the interest and take it to the income statement.
Income statement.
Yes, as expenses, interest. Are you getting the idea? Then that interest will now be added back to the revenue from the goods. The reason is that.
you said you buy the thing at a premium.
So
How does it become an expense?
So let me do this for you. Let me do this for you.
Interest on loan.
Because say we turn at a premium, no, I say we build the reserves at all. Are you getting it? So that when you get there,
Oh no, you buy it at a premium from the buyer.
yeah,
Sorry.
you get the idea. So for instance,
So that means you are rather losing.
Nasa mama osika.
Na make no.
Eh.
First, not before say ba ko no na.
No.
Premium.
Yes,
Ah.
that's the idea. So this is the thing. Let's say you sell goods of say $20,000 with a right to repurchase, and you purchase at a premium of say maybe 5%, 5% premium. So what does that mean? It means that, for instance, this one will be subtracted from their revenue in the income statement. That's the first step. Second step, this 20,000 will be recognized as what? FL, financial liability. Are you getting it? Then on that you will pay what? 5%, chargeable every year. So that 5% is the finance cost or what? Interest. And that will be debited to your income statement, and you will credit the financial liability. So you build a reserve so that when it is time for you to pay, the money is accumulated and then you use it to pay. It looks simple, right? That's it. So 3 things. 1, issue of shares, equity, issue of redeemable loan notes, liability, issue or sale of goods with a repurchase option. We treat this as a liability.
So the financial assets in the balance sheet, where would it go?
If, like, you are the buyer, it's part of your non-current assets. Always. And these are, if it is liability, non-current liability, and then what? Equity will also be under equity. We will add it to the shares of the company. Let's go. So please, if you forget anything in financial instruments, don't forget this statement. Because the categorization of the financial instrument is critical. It's critical. And this is the thing. Do we have an obligation to repay? Do we have an obligation to give the person's money back? If we have an obligation, boom, it's a liability. If we don't have any obligation, it's an equity. So based on that, it means there are 2 types of financial instruments. So let's look at the way we account for the financial instruments, and that is financial assets and financial liability. So let's start first with financial assets. How do we account for them? Financial assets.